Fact or fiction, the S&P 500 always goes up. Welcome back to The Motivated Investor, where we explore the intriguing world of investing and finance. Today, we're diving deep into a popular belief: the S&P 500 always goes up. Is this statement a fact or mere fiction? Let's find out together. The S&P 500 is one of the most closely watched stock market indices in the world. It represents the performance of 500 of the largest publicly traded companies in the United States. Many investors view it as a benchmark for the overall health of the stock market, but the idea that it always goes up is something worth examining closely. First, let's consider the historical performance of the S&P 500. Over long periods, the index has indeed shown an upward trend. This is largely due to the growth of the companies within it, the overall economy's expansion, and the power of compound growth. Many investors believe that by simply investing in the S&P 500, they can achieve steady returns over time. But does that mean it always goes up? While it is true that the S&P 500 has delivered positive returns over the long haul, it has also experienced significant downturns. For instance, during economic recessions or major global events, the index can drop substantially. The dot-com bubble in the early 2000s and the financial crisis of 2008 are prime examples where the S&P 500 saw considerable declines. These drops remind us that markets can be volatile and unpredictable in the short term. Now, let's talk about the concept of time in the market versus timing the market. Many financial experts advocate that staying invested in the S&P 500 for the long term can lead to positive outcomes, even during turbulent times. This strategy is based on the idea that the market tends to recover from downturns, eventually reaching new highs. However, it's essential to remember that not every investor has the same experience. Those who entered the market just before a significant downturn may have a different perspective on the index's reliability. Another critical factor to consider is the impact of inflation. While the S&P 500 may go up in nominal terms, inflation can erode the actual purchasing power of those gains. This means that even if the index rises, it's essential to look at the real returns, taking inflation into account. An investor's perception of the S&P 500's performance can vary significantly depending on these factors. Moreover, market sentiment plays a substantial role in the S&P 500's fluctuations. Investor behavior, news cycles, and economic indicators can create volatility, leading to short-term price changes that may contradict the belief that the index always goes up. Market psychology can be unpredictable, and fear or greed can lead to drastic movements in stock prices. So, is the statement that the S&P 500 always goes up a fact or fiction? The answer lies somewhere in between. While the index has shown a long-term upward trend, it is not immune to declines and volatility. Investors should approach this belief with a balanced perspective, understanding both the historical performance and the inherent risks involved. As we wrap up this discussion, it's crucial to remember that investing requires careful consideration and a long-term view. The S&P 500 can be a valuable part of a diversified portfolio, but it's essential to be aware of its ups and downs. Thank you for watching this episode of The Motivated Investor. If you found this video insightful, please give it a thumbs up and subscribe to our channel for more content on investing and finance. Your support helps us create more valuable resources for you. Until next time, happy investing.